Are you a borrower or a saver? Well, most of us will be both at one time or another. Whether you're at the bank to get a loan or to open a savings account, you'll want to know about interest rates. There are two types of interest rates that we will talk about. The ones that you get from your bank and the ones your bank gets. We have a part 2 for the second type, so check it out after this one. But let's start with the basics. Interest rates. Interest rates are the extra money you earn when you save money, or the extra money you pay when you borrow money. Interest rates affect you and your finances, so getting a handle on them will help you make savvy financial decisions. When interest rates go up, you'll pay more for borrowing money, but you earn more on the money you've saved. And when interest rates come down, borrowing will be cheaper, although you won't earn as much on your savings. So, by understanding interest rates, you can adjust your borrowing and saving strategies like a pro. Let's look at interest rates and savings in more detail. Banks will pay you a rate of interest on your savings to encourage you to leave your money with them. By paying interest, banks attract more deposits, which they can then offer to other people or businesses as loans. And all the while, you'll be earning a small return on your savings, helping preserve your money's value against inflation. Let's say your bank offers you interest on your savings, known as a savings rate, of 1% a year. With €100 in your account, you would earn €1 at the end of the year. But if the bank offered you a rate of 3.5%, you would earn €3.50. So a higher savings rate means your money grows faster over time. And that's how interest rates help build savings. Now, let's look at how interest rates affect the amount that you can borrow. Imagine you want to buy a car. And unless you've been saving up, or hit the jackpot, you'll have to borrow the money. And that's where banks come in. Banks charge a rate of interest on the money they lend you, what's known as a lending rate. Imagine you have to pay a 3% lending rate on a €10,000 loan. When you repay the loan, you'd pay the bank €300 on top of the initial 10,000 that you borrowed. And sometimes banks too need to borrow money, or they want to earn interest on the money they already hold. In those cases, they can turn to their central bank. We've already covered quite a lot. Next up, interest rates set by central banks. That's the story of part 2, so see you there.